Every nation on the planet carries debt. America owes $38 trillion. Japan owes $9 trillion, and the whole world owes $315 trillion, triple the size of global economic output. But there's a paradox that should scare you senseless. If everyone's in debt, who exactly gets paid back? The answer isn't what you're thinking, because when you trace the creditor chain, when you track who genuinely holds the debt, you uncover something disturbing. The planet doesn't owe funds to any particular entity. It owes funds to itself. But four individuals, four bankers spanning 3 centuries, engineered it that way. Deliberately, they constructed a mechanism where debt can never get repaid, where governments borrow perpetually, where interest streams eternally upward, and where the architects who designed the trap profit from every payment, every crisis, every bailout. This isn't conspiracy theory, this is documented history. The meetings occurred, the contracts exist. The mechanisms are public information. And once you see how they constructed it, you'll grasp why $38 trillion isn't a crisis requiring solutions. It's the mechanism functioning precisely as engineered. Before 1694, monarchs borrowed funds the traditional method. They'd approach merchants or aristocrats, promise repayment with interest. And if they couldn't settle, they'd default. Creditors lost funds. Kings borrowed from different sources. It was risky for lenders, embarrassing for kings. But it was contained. Debt was temporary, either repaid or defaulted. The mechanism cleared. William Patterson transformed everything. He was a Scottish merchant and financial schemer who'd attempted and failed multiple times to get wealthy. In 1691, he had a concept that would reshape civilization. England was battling France. King William III required funds desperately. The treasury was depleted. Tax income couldn't cover war expenses. Traditional lenders were refusing fresh loans because England had defaulted previously. Patterson approached the king with a proposition. He would organize a group of wealthy merchants to lend the government £1.2 million. That's roughly £300 million in current currency, a massive sum. But here's the innovation. The loan would never get repaid. Instead, the government would settle interest perpetually, 8% yearly. And to administer this arrangement, Patterson proposed establishing a fresh institution. The Bank of England. The mechanics were revolutionary. The merchant lenders would provide their gold to the Bank of England. The bank would lend it to the government. The government would settle interest yearly from tax income, and the bank would settle that interest to the merchant lenders. But here's the critical detail. The government wouldn't repay the principal, ever. The loan was permanent. Why would merchants accept this? Because the interest payment was guaranteed by Parliament. It was supported by the government's taxing authority. As long as England could tax its populations, the interest would stream. And the banknotes the lenders obtained in exchange for their gold could be traded. They were as valuable as currency. Better than currency because they paid interest. Parliament approved Patterson's scheme in 1694. The Bank of England was chartered. The merchants supplied their gold. The government obtained its war funding, and for the first time in history, national debt became permanent, not a crisis to resolve, a feature of the mechanism. And here's what nobody explains about why this was brilliant for the bankers. The government settled 8% interest yearly on £1.2 million. That's £96,000 annually. Forever, the merchants had fundamentally purchased an annuity from the government. As long as England existed, as long as it could tax, the funds streamed. And if they wanted their gold returned, they could sell the banknotes to another party. The debt was transferable but never repayable. But Patterson's genuine genius was what arrived next. The Bank of England was granted the right to issue banknotes supported by the government's debt. They could print paper currency up to the value of the loan. This generated currency out of debt. The government's IOU became currency. And the more the government borrowed, the more currency could be generated. This is the template. Government borrows, never repays principal. Settles interest perpetually, and the debt itself becomes currency. It's brilliant if you're a banker, catastrophic if you're a taxpayer. Because you're settling interest on debt that will never vanish. Within 50 years, every significant European authority copied the model. France established the Banque Générale. The Netherlands already possessed sophisticated banking but formalized government debt issuance. And by 1790, the newly independent United States adopted the identical mechanism. Alexander Hamilton explicitly modeled America's financial mechanism on the Bank of England: permanent debt. Interest settled from taxes, bonds traded as currency. Patterson died in 1719, not particularly wealthy, despite establishing the Bank of England. But the mechanism he constructed persists 331 years later. The Bank of England still exists. British government debt has never been settled off. It's been refinanced, rolled over, and expanded, but never eliminated. The debt trap was set in 1694, and every government since has walked into it willingly. By the early 1800s, European governments had embraced debt. They borrowed for wars, for infrastructure, for operating expenses. But there was no organized market. Each loan was negotiated individually. Interest rates varied wildly. And only the wealthiest merchants could participate. Nathan Rothschild transformed that. He industrialized sovereign debt. The Rothschild family started as money changers and traders in Frankfurt. By 1800, the 5 Rothschild brothers had established banking houses in 5 major European cities: London, Paris, Frankfurt, Vienna, Naples. This network was unprecedented. They could transfer funds across borders faster than anyone else. And they utilized this to dominate sovereign debt issuance. Nathan Rothschild in London was the strategic genius. During the Napoleonic Wars, Nathan arranged loans for Britain. But his innovation was how he structured them. Instead of lending directly to the government, he purchased government bonds at a discount and resold them to investors at a markup. He established a secondary market. Government required funds. Rothschild supplied it immediately. Then he sold the bonds to pension funds, insurance companies, and wealthy individuals. The government obtained its funds fast. Rothschild collected the spread, and investors obtained a tradable asset. But here's where it gets darker. Rothschild didn't just finance governments. He positioned himself so governments had zero choice but to utilize him. In 1815, at the Battle of Waterloo, Nathan Rothschild famously learned of Napoleon's defeat before anyone else in London. His courier network was faster than official channels. He utilized this information to manipulate the bond market. First, he sold British bonds, signaling that Britain was losing. Prices collapsed. Other investors panicked and sold. Then, after prices crashed, Rothschild purchased massive quantities at rock-bottom prices. When news of British victory arrived the next day, bond prices surged. Rothschild made millions, not from insider trading as we'd label it currently, but from controlling information and market timing. This established the Rothschild model. Control the information, control the issuance, control the market. By 1820, the Rothschilds dominated European sovereign debt. If a government required borrowing, they went through the Rothschilds. Because the Rothschilds controlled the investor network, they possessed the distribution, and they set the terms. Here's why this matters for the debt trap. Before Rothschild, governments could theoretically refuse to settle. If a monarch defaulted, his creditors lost funds and the mechanism reset. But Rothschild made sovereign debt tradable across borders. A British bond might be owned by a French investor who sold it to a German bank who utilized it as collateral for a loan to an Austrian aristocrat. The web of ownership became so complex that defaulting wasn't just refusing one creditor. It was collapsing an entire international financial network. This is the Rothschild innovation: make debt so interconnected that default becomes impossible, not because governments are responsible. Because default would trigger systemic collapse, governments became trapped. They had to keep settling, and they had to keep borrowing to settle the interest on old debts. The debt trap was no longer just permanent, it was inescapable. The Rothschild family wealth peaked in the mid-1800s. They were the wealthiest family on the planet, richer than any monarch. And that wealth originated from one source: Interest on sovereign debt. They didn't produce anything, didn't construct anything. They lent funds to governments and collected interest perpetually. The mechanism Patterson established in 1694. Rothschild industrialized by 1815. And every government in Europe was caught. By 1900, America was becoming an economic powerhouse. But it still possessed a primitive financial mechanism. Banks operated independently. Money supply was tied to gold. And there was no central apparatus to manage debt. J.P. Morgan fixed that, not for the public benefit. To protect his banking empire in 1907, there was a financial panic. Stock prices crashed, banks failed, and the economy seized up. J.P. Morgan personally organized a bailout. He gathered the major New York bankers in his library, locked the doors, and forced them to pledge their own funds to stabilize failing banks. It worked. The panic concluded, and Morgan became the de facto central banker of America. But he was 70 years old. He knew he couldn't do it again. So Morgan and his associates, the most powerful bankers in America, designed a permanent solution. They required a central bank. But Americans hated central banks. The first and second banks of the United States had been shut down by populist opposition, so Morgan's group disguised it. In 1910, Morgan's associates, including Senator Nelson Aldrich and representatives from the largest banks, held a secret meeting on Jekyll Island, Georgia. For 9 days, they designed the structure of what would become the Federal Reserve System. The meetings were secret because they knew if the public discovered that bankers were designing the nation's monetary mechanism, there would be riots. The plan was brilliant political manipulation. The Federal Reserve wouldn't be labeled a central bank, it would be labeled a Federal Reserve System. It wouldn't be one institution, it would be 12 regional banks, it wouldn't be controlled by Wall Street. It would be overseen by a board of governors appointed by the president. It looked decentralized, democratic, public. But the structure ensured banker control. The regional Federal Reserve banks were privately owned by member banks. Those banks elected the boards of the regional feds, and the regional feds elected the Federal Reserve Board. The government appointed some members. But the bankers controlled the mechanism. And the most significant authority, the authority to generate currency and purchase government bonds, was granted to the Federal Reserve Bank of New York, which was controlled by the largest Wall Street banks, Morgan's banks. The Federal Reserve Act passed Congress in December 1913, largely because most representatives didn't comprehend what they were voting for. And immediately, the debt trap expanded. Now the government didn't just borrow from banks, it borrowed from the Federal Reserve, which could generate currency to purchase bonds. Unlimited demand for government debt. Here's why this matters. Before the Federal Reserve, there was a limit to how much the government could borrow. Banks only possessed so much currency to lend. But the Federal Reserve could generate currency by purchasing government bonds. The government issues a bond, the Fed purchases it with newly generated currency. The government spends the currency, and the debt goes on the Fed's balance sheet, backed by nothing except the promise that taxpayers will service it perpetually. This is the apparatus that enables infinite debt. The Federal Reserve ensures there's always a purchaser for government bonds, always demand. So the government never has to stop borrowing. It can roll over debt perpetually because the Fed will always purchase it. And the interest payments stream from taxpayers to the banks that own the Federal Reserve mechanism. Morgan died in 1913, the same year the Federal Reserve was established. But his legacy is the structure that makes the current $38 trillion in U.S. debt possible. Without the Federal Reserve, the government couldn't borrow at this scale. The market wouldn't support it. But with the Fed as a guaranteed purchaser, there's no limit. The debt trap became infinite. By the 1970s, the debt trap Patterson, Rothschild, and Morgan constructed was functioning globally. Every developed nation borrowed, rolled over debt, settled interest. But developing nations were different. They borrowed for infrastructure. And many couldn't keep up payments. The debt trap was reaching its limits. Until Paul Volcker made it permanent. Volcker was Federal Reserve Chairman from 1979 to 1987. and he confronted a crisis. Inflation was exceeding 10%. U.S. credibility was eroding. Foreign governments were losing faith in the dollar. He required stopping inflation, even if it meant causing a recession. So in 1979, Volcker raised interest rates dramatically. The federal funds rate went from 11% to 20%, the highest in American history. This crushed inflation. But it possessed another effect. Developing nations had borrowed billions in dollars during the 1970s when rates were low. Now those loans were due. And the interest rates had tripled. Mexico owed $80 billion, Brazil $60 billion, Argentina $40 billion. And they couldn't settle. The interest alone exceeded their export revenues. In August 1982, Mexico announced it couldn't make payments. Default. This should have triggered global financial collapse. American banks had lent most of that currency. If Mexico defaulted, Citibank, Bank of America, Chase Manhattan, all would take massive losses. Some might fail. The entire banking mechanism was at risk. Volcker could have let it occur, let the banks take losses, let the market clear. But he didn't. Instead, he orchestrated a bailout through the International Monetary Fund. The IMF would lend Mexico, Brazil, Argentina, and others enough currency to keep making interest payments to American banks. The loans were labeled structural adjustment loans. And they arrived with conditions. The conditions were brutal. Governments had to cut spending, privatize state assets, open markets to foreign investment, devalue currencies, basically dismantle their economic sovereignty in exchange for the currency to keep settling interest. And here's the key. The IMF loans didn't reduce debt, they just rolled it over, made it manageable but permanent. This is the Volcker innovation. When debt becomes unpayable, don't forgive it, restructure it, lend enough to keep interest payments streaming, and extract political and economic concessions in exchange. The debt trap became a tool of control. Countries that couldn't settle were forced to open their economies, sell their assets, and submit to foreign economic policy in exchange for the privilege of staying in debt. This pattern has repeated for 40 years. Greece in 2010, Argentina in 2001, Sri Lanka in 2022. Every time, the identical structure: IMF loans to keep settling interest, austerity imposed, sovereignty surrendered, and the debt never eliminated, just restructured, made perpetual. Volcker died in 2019, but his legacy is the apparatus that ensures the debt trap is global and inescapable. Even when countries can't settle, they're not permitted to default. They're refinanced into permanent indebtedness, and the interest keeps streaming to the creditors. The identical banks, the identical institutions, the identical mechanism Patterson established in 1694. Now let me reveal how these four architects constructed a mechanism where debt is infinite and escape is impossible. Start with Patterson's model. Government borrows, settles interest perpetually, never repays principal. Add Rothschild's innovation, make the debt tradable globally. So it's not one creditor, it's a web. Default collapses the mechanism. Add Morgan's apparatus, central banks generate currency to purchase government bonds. Unlimited demand, government can always borrow more. Add Volcker's trap. When countries can't settle, restructure, don't forgive, keep the interest streaming. The result is what we possess currently. $315 trillion in global debt, government debt, corporate debt, household debt. None of it will ever be repaid. All of it settles interest, and all of it is connected through the financial mechanism. So default anywhere threatens collapse everywhere. Here's the specific apparatus. The U.S. government issues $38 trillion in debt. Who owns it? About $20 trillion is owned by the American public. Pension funds, mutual funds, insurance companies, banks, and the Federal Reserve. These institutions purchase treasury bonds because they're considered safe assets. But those bonds settle interest, about $1 trillion annually. Now that interest originates from taxes. So taxpayers send currency to the government sends it to bondholders. The bondholders are mostly institutions owned by the wealthy. It's a transfer from workers to capital, every year forever. The other $18 trillion is owed to the government itself. Social Security Trust Fund, Medicare Trust Fund. The government borrowed from these programs and spent the currency. Now it owes itself, but ultimately taxpayers owe. Because when Social Security requires redeeming those bonds, the government has to raise taxes or borrow more to settle. It's a shell game. But the interest streams regardless. Now scale it globally. Japan owes $9 trillion, mostly to Japanese institutions, and the Bank of Japan Europe owes $14 trillion, mostly to European banks and the ECB. China owes significant domestic debt held by state banks. Every country is running the identical mechanism, and they're all interconnected. Japan holds U.S. treasuries, the U.S. holds European bonds through the IMF, Europe holds developing nation debt through the World Bank. It's circular, everyone owes everyone. And the interest streams upward to the institutions that manage the debt. Here's why this can never conclude. If the U.S. settled off its $38 trillion, the currency supply would collapse. Because dollars are generated when the government borrows. If it settled off the debt, those dollars would vanish. Deflation, depression, economic collapse. So the government can never settle it off. It has to keep borrowing, keep rolling it over, and keep settling interest. The identical is true globally. If every government settled off its debt, the global currency supply would shrink by 2/3. There wouldn't be enough currency to conduct trade. The mechanism would seize. So debt can't be eliminated. It's structural. Necessary by design. And here's who profits. The institutions that hold the debt: BlackRock, Vanguard, State Street, Fidelity. These asset managers control tens of trillions. They purchase government bonds with other people's currency, pension funds, retirement accounts, insurance premiums, and they collect the interest, about $1 trillion annually from U.S. debt alone, plus interest from Japan, Europe, everywhere. That trillion annually in interest payments streams from taxpayers to bondholders. It's the largest wealth transfer in history. Continuous, structural, and invisible to most populations because it's not labeled a tax. It's labeled debt service, but it's the identical apparatus. Workers settle, institutions collect, and the debt never decreases. Now here's the final piece. The four architects didn't conspire together. They lived in different centuries, but they each resolved a crisis in a method that benefited bankers, and each resolution built on the previous one. Patterson made debt permanent in 1694. Rothschild made it global in 1815. Morgan made it infinite in 1913. Volcker made it inescapable in 1982. Together they constructed a mechanism where governments borrow perpetually and settle interest eternally. And the populations who control the bonds, who manage the debt, who collect the interest, they're the ultimate beneficiaries, not governments, not taxpayers, the financial institutions. And here's the final truth. $38 trillion isn't a crisis for them, it's a business model. Every dollar of debt is an asset on someone's balance sheet. It settles interest. It supplies collateral for more borrowing. And as long as confidence holds, as long as populations believe the government will settle interest, even if it never repays principal, the mechanism functions. The debt trap is complete. Escape isn't possible, not without collapsing the entire financial mechanism. 4 architects, 3 centuries, 1 mechanism. And everyone on Earth is now caught inside it. If this transformed how you see government debt, if you finally comprehend that $38 trillion isn't an accident or mistake, but a mechanism functioning precisely as engineered, then you're starting to see how power genuinely operates. Subscribe if you want to comprehend how the apparatus was constructed and who's operating it. Because they're not going to teach you this in school. They're going to teach you that debt is a crisis to resolve. But the architects knew better. Debt isn't a crisis, it's the foundation. And interest is the rent we settle to live in their mechanism.